What if you could peer into the minds of Wall Street's most powerful titans, understand their secret strategies, and know exactly when they were buying and selling? That's pure fantasy. But for one teenager, it was his day job. This is the story of how Richard Wyckoff went from the bottom rung of the financial ladder to a market master, all by spying on the moves of legends like J.P. Morgan, and what he discovered would change trading forever. The year is 1888. Wall Street isn't the digital machine it is today. It's a chaotic, unregulated pit of roaring traders, scribbled notes, and clattering ticker tapes. Fortunes are made and lost in a blink, often based on rumors, whispers, and outright manipulation. This is the Gilded Age, and New York City is its thrumming, gilded heart. Into this storm steps a boy named Richard Wyckoff. He's about 15 years old, and he's not a banker's son or some privileged heir. He's a stock runner. It was about the lowest job you could get on the Wall Street food chain. His days were a blur, darting between brokerage houses, delivering stock certificates and orders for the most powerful men in America. He was an invisible cog in a colossal machine, a ghost weaving through the titans who commanded the nation's capital. Imagine it, a young Wyckoff, dodging men in top hats, rushing past the very architects of modern industry. One minute, he's delivering a message to a firm connected to the formidable J.P. Morgan, a man whose financial power could rival the U.S. government itself. The next, he's near the offices of notorious stock operators like James R. Keene, a name spoken in whispers of awe and fear. For these men, the market was a grand chessboard. They were the grand masters, moving entire industries like pawns. They operated on a level far beyond public understanding. Their strategies hidden, their intentions masked. The average person, the retail investor of the day, was little more than cannon fodder in their campaigns, a source of cash to be exploited. Most people in Wyckoff's shoes would have just seen the chaos. The shouting, the panic, the greed. They would have kept their heads down, collected their tiny paycheck, and gone home. But Richard Wyckoff was different. He wasn't just delivering messages. He was absorbing everything. He was watching. He was listening. And most importantly, he was thinking. With every order he carried, every conversation he overheard, a powerful curiosity began to burn inside him. He started seeing patterns in the madness. He saw that the movements of stocks weren't random. They weren't just a jumble of numbers. They were the result of deliberate, calculated actions. He realized he was in a unique position, an outsider on the inside, a spy in the House of Capital. He had a front row seat to the greatest financial show on earth, and he became determined not just to watch it, but to understand it. This was the start of his real education. The Wall Street jungle was his classroom, and its most dangerous predators were about to become his unwilling teachers. For young Richard Wyckoff, the ticker tape wasn't just a stream of paper, it was a living language. While everyone else saw a blur of symbols and prices, Wyckoff started to see a story unfolding in real time. This thin ribbon of paper was the pulse of the market, and he dedicated himself to reading it. This skill was known as tape reading, a lost art in today's world of digital charts. Back then, it was the essential tool for any serious trader. It took immense concentration and an intuitive feel for the market's rhythm. A great tape reader didn't just see that a stock was at a certain price. They could feel the pressure behind the trades. They'd notice the volume, the number of shares changing hands, and interpret its meaning. Was a huge wave of selling being absorbed by an even larger unseen buyer? Was the stock rising on weak volume, suggesting the rally was a fake out? This was the code Wyckoff had to crack. His job as a runner gave him the perfect vantage point. He saw the orders before they hit the tape. He knew which powerful operators were buying and how much. Then he watched the tape to see the ripple effect of their actions. He was essentially looking over the shoulders of men like J.P. Morgan and, as he would later observe, the legendary trader Jesse Livermore. He saw how this smart money operated. They didn't chase trends, they created them. They didn't just react to the news. They were the news. A deep and profound question began to form in Wyckoff's mind. How could a small-time player like him trade in harmony with these giants instead of getting crushed by them? He started connecting the dots. He studied the manipulative campaigns of the era's great speculators. He saw how they quietly accumulate a massive position in a stock without alerting the public. Then, once they were set, they'd strategically leak good news to attract public interest and drive the price up. And at the peak of the buying frenzy, when the public was clamoring to get in, these same operators would be quietly selling their shares to the unsuspecting masses at inflated prices. Wyckoff's slow, dawning realization was this: the secret wasn't a magic formula or a hot tip. The secret was printed on the tape every single day. The actions of the market titans, no matter how secretive, left footprints. They left clues in the relationship between price and volume. And if he could learn to read those footprints, he could anticipate their next move. Instead of being a pawn in their game, he could ride the waves they created. This quest to decode the intentions of Wall Street's elite became his life's purpose. Wyckoff's path from observer to participant was anything but smooth. Knowing the game plan didn't instantly translate to easy profits. Wall Street in the late 19th and early 20th centuries was a brutal place, and it extracted its tuition in the form of devastating losses. By his mid-20s, Wyckoff wasn't just a runner anymore. He had climbed the ladder and was now running his own brokerage firm. This gave him an even deeper insight. He was now handling orders, not just delivering them. Around 1900, his firm was in the thick of it, even handling orders for some of the era's most powerful operators. He was seeing the game from the inside, witnessing firsthand how the smart money engineered their campaigns. But seeing the plan and profiting from it were two very different things. Those early years were a constant struggle. For every pattern he thought he'd nailed, there was a head fake, a shakeout where the market would suddenly move against the logic, scaring smaller traders out of their positions right before the real move began. Wyckoff realized these weren't random. They were deliberate traps set by the large operators to clear out the weak hands. Imagine the frustration. You see a stock being quietly bought up. You buy in, waiting for the big move. Then, suddenly, the price plummets. Panic sets in. You sell at a loss, only to watch in agony as the stock reverses and makes the exact climb you predicted. This was a rite of passage for retail traders, and Wyckoff wasn't immune. But for him, these losses weren't failures, they were data points. Each painful trade was a lesson in market psychology. He learned that the game was rigged against the emotional and impatient. The big operators preyed on fear and greed. They knew the average person would buy at the top, fueled by FOMO, and sell at the bottom, consumed by panic. Wyckoff knew he had to become something else. He had to be cold, calculating, and objective. This period of struggle forged his resolve. He doubled down on his studies, spending countless hours poring over charts he drew by hand. He sought out others who understood the market's deeper currents, even holding weekly meetings with Charles Dow, the founder of Dow Jones and Company, and the father of technical analysis. Wyckoff blended Dow's ideas about trends with his own intense focus on price and volume, creating something uniquely his own. He wasn't just learning a strategy, he was forging a methodology, a system built on logic and observation. His early struggles taught him the most valuable lesson of all. To succeed, you couldn't just have a theory. You needed a rock-solid method and the mental discipline to follow it without emotion. He was learning to stop trading the market and start trading the operators behind the market. Through years of intense observation and painful trial and error, Richard Wyckoff had a breakthrough. It was an idea so powerful and simple it would become the cornerstone of his entire philosophy. He called it the Composite Man. Wyckoff told his students to look at the entire market as if it were controlled by a single, intelligent being. All the fluctuations in the market, he wrote, should be studied as if they were the result of one man's operations. This theoretical figure, the Composite Man, was the embodiment of all the smart money, the institutions, the powerful banking syndicates, the legendary traders. This entity, he said, sits behind the scenes, carefully planning and executing campaigns to manipulate stocks. The Composite Man acts in the complete opposite way of the average trader. He's patient, disciplined, and unemotional. His goal is simple: to buy from the public at the lowest possible price and sell back to them at the highest possible price. To do this, the Composite Man must be sneaky. If he wants to buy 1 million shares, he can't just place one giant order. That would send the price soaring. Instead, he has to quietly accumulate his position, buying in small chunks over a long time, usually when the market is pessimistic and nobody else wants to buy. He absorbs the selling from panicked retail traders, creating a floor under the price. During this phase, he's also a master of deception. He'll engineer shakeouts or springs, sudden sharp price drops designed to trigger stop losses and scare the last remaining sellers into giving up their shares. He wants to make sure there are as few shares for sale as possible before he begins the next phase. Once he has his full position, his behavior changes. He's ready for the markup. With most of the available shares now locked up, it takes very little buying pressure to send the stock soaring. Now he might even encourage public participation. Positive news stories appear. The stock hits new highs, attracting attention. The public, which was too scared to buy during the quiet accumulation, now rushes in, chasing the momentum. At the peak of this optimism, when the public is euphoric and greedy, the Composite Man begins his final act. He reverses his process. He starts to quietly distribute, selling his massive line of stock to the very crowd that is now desperate to buy it. This distribution can look like a sideways trading range at the top. The upward momentum stalls, but the price doesn't collapse right away, because every dip is bought by eager retail traders who think it's just a small pullback. Finally, when the Composite Man has sold all his shares, he pulls his support from the market. With no large buyer to absorb selling pressure, the price collapses. This is the markdown. The public, who bought near the top, now panics and sells in a cascade of fear, often selling their shares right back to the Composite Man, who might be waiting at the bottom to start the whole cycle over again. This concept was revolutionary. It gave traders a narrative. The chart was no longer a series of random wiggles. It was a story with a protagonist. Wyckoff's special skill was reading this story. By analyzing price and volume, he could identify the Composite Man's footprints. He had created a map to navigate the market jungle, a way to trade with the smart money, not against it. Armed with his Composite Man theory, Richard Wyckoff was no longer just a student of the market. He was becoming a master. He had crossed the threshold from a struggling speculator to a consistently profitable trader. His success wasn't just theoretical. He was getting rich. He eventually made enough money to buy a sprawling 9.5-acre estate and a mansion in Great Neck, New York, living near other industry titans like the head of General Motors. One of his most legendary trades came between 1916 and 1918. He was focused on U.S. Steel, a behemoth of American industry. Using his methods, he saw a major market top in the making. He spotted the classic signs of distribution: high volume with little upward price progress, signaling that large operators were unloading shares. Wyckoff took a massive short position, betting the stock would fall. When the market broke, his profits were huge and his reputation soared. His allies were other astute traders who understood the deeper game. He famously traded research notes with Jesse Livermore, another master tape reader. While their styles were different, they both understood the market was a game of psychology and strategic positioning. In 1921, Wyckoff even became a founder of the New York Curb Exchange, cementing his status as a key figure in the financial world. His enemies, however, were always there. They were the very manipulative forces he studied. The Composite Man was always laying traps. The market itself was an enemy, with its volatility and unpredictable shocks. Wyckoff's primary defense wasn't genius, but discipline. He became a huge advocate for risk management, emphasizing the use of stop losses on every single trade, a practice that wasn't common at the time. He knew he wouldn't be right every time, and the key to survival was cutting losses quickly. He meticulously drew his own bar and point-and-figure charts by hand, using them to conduct what he called comparative strength analysis. Before buying a stock, he'd look for ones that were outperforming the broader market. For short positions, he hunted for the weakest of the herd. This ensured he was always fishing in the right ponds, placing his bets where the institutional force was strongest. He saw the chart not as a crystal ball, but as a news report. It told him the story of the battle between supply and demand. And his success was the ultimate proof of this concept. By decoding the intentions of the market's biggest players, he was able to consistently place himself on the right side of major trends, building a fortune not through luck, but through mastery of the game. By the late 1920s, America was in the grip of a speculative fever. The Roaring Twenties were in full swing, and the stock market seemed like a one-way ticket to riches. Shoeshine boys were giving stock tips, and the public piled into the market with borrowed money, convinced a new era of permanent prosperity had arrived. It was pure mania. But as the party raged, Richard Wyckoff was watching the tape with a growing sense of dread through the lens of his Composite Man theory. He saw something the euphoric public couldn't. He saw massive, unprecedented distribution. On his hand-drawn charts, the story was crystal clear. Powerful upward price moves were happening on enormous volume, but the progress was slowing. The market would churn sideways for days on a massive turnover of shares. To an amateur, this looked like a healthy pause. To Wyckoff, it was the unmistakable footprint of the Composite Man selling everything he owned to the greedy crowd. He saw what he called an upthrust, a final, exhaustive move to a new high that quickly failed, the last gasp of the bull market, designed to lure in the last of the dumb money. He saw volume drying up on rallies and expanding on declines, a sure sign the big money was no longer supporting the price. The massive cause, the campaign of distribution, was about to produce its devastating effect. While other commentators predicted ever higher prices, Wyckoff began issuing stark warnings to his clients. He told them the party was over. He advised them to get out of stocks, move to cash, or even take short positions to profit from the coming decline. This must have been incredibly difficult advice to follow. It meant leaving the party while everyone around them was still getting rich. It meant trusting Wyckoff's cold analysis over the euphoric sentiment of an entire nation. Then came October 1929. Black Thursday, then Black Tuesday. The floor fell out. The ticker tapes ran hours behind, unable to keep up with the flood of selling. Fortunes built over a decade were wiped out in an afternoon. The dreams of the Roaring Twenties evaporated into a nightmare of financial ruin. But Richard Wyckoff and his clients were safe. They were not only protected from the crash, but were positioned to profit from it. The 1929 crash was his ordeal and his ultimate vindication. It was the single greatest proof of concept for his life's work. While the world descended into the Great Depression, the crash solidified Wyckoff's reputation as a market master. He hadn't just predicted the biggest financial collapse in American history. He had read it on the ticker tape well in advance. He saw the Composite Man walking out the door and quietly showed his followers the exit right behind him. Having achieved massive success and proven his methods beyond all doubt, Richard Wyckoff could have easily retired to his mansion and lived out his days in luxury. But the 1929 crash and the devastation it caused ignited a new passion in him: education. For decades, he'd watched from his unique vantage point as the public was consistently fleeced by the large operators. He saw them as lambs led to the slaughter, drawn in by greed at the top and driven out by fear at the bottom. He felt a growing responsibility to level the playing field. This mission wasn't entirely new. As early as 1907, he had founded the Magazine of Wall Street, the first of its kind, with the goal of teaching the public the real rules of the game. It was a huge success, with a circulation of over 200,000 at its peak. In 1922, he published a series of exposés in the Saturday Evening Post titled Bucket Shops and How to Avoid Them, which helped shut down countless fraudulent brokerages that were essentially betting against their own clients. After the crash, this educational drive became his primary focus. He believed that if the average person could learn to think like the Composite Man, they could avoid being his victim. They could learn to spot the signs of accumulation and distribution and trade with the powerful forces that move the market. He saw this not just as a business, but as a moral imperative. He had spent his life decoding the secrets of Wall Street's elite. Now he would spend the remainder of his years sharing those secrets with the world. He was no longer just a speculator. He had transformed into a market educator, a guardian for the retail trader. Wyckoff's ultimate gift to the world was the Wyckoff Method. In 1931, with millions still reeling from the Depression, he founded a school later known as the Stock Market Institute. Through it, he offered a correspondence course that laid out his entire system. For the first time, the secrets he had uncovered were available to anyone. He would continue this educational work until his death in 1934. The Wyckoff Method isn't some black box system. It's a complete framework for understanding market dynamics built on a few core principles. First, he laid out 3 fundamental laws. The law of supply and demand. When demand is greater than supply, prices rise. When supply is greater than demand, prices fall. The law of cause and effect. For every major move, the effect, there's a period of preparation. The cause. This cause is the energy built up during a sideways trading range, the period of accumulation or distribution. The longer the cause, the more powerful the effect. The law of effort versus result. This is your warning sign. Effort is volume and result is price movement. If a massive amount of volume, the effort, produces only a tiny price change, the result, it signals a trend might be ending. Building on these laws, he gave students a 5-step approach to the market. Step 1. Determine the market's trend. Are we in a broad uptrend or downtrend? You want to swim with the current. Step 2. Select stocks in harmony with the trend. In an uptrend, find stocks that are even stronger than the market. In a downtrend, find ones that are weaker. Step 3. Find stocks with a cause that justifies a big move. Look for stocks that have been accumulating for a long time. Step 4. Determine the stock's readiness to move. Has the stock completed its cause and is it ready to launch? Wyckoff had specific tests to check for this. Step 5. Time your entry with the overall market. Improve your odds by entering the trade when the whole market starts moving in your favor. This structured approach transformed trading from a wild gamble into a logical strategic exercise. He wasn't giving people fish. He was teaching them how to fish. The Wyckoff Method was the ultimate tool for transparency, exposing the market's underlying mechanics for all to see. This was his enduring legacy. Richard Wyckoff's story is the ultimate tale of the American underdog. He started at 15, an invisible runner in the canyons of Wall Street, and through pure grit and relentless observation, rose to become a legend of technical analysis. He didn't have a fancy education or a rich family. His classroom was the trading floor, and his teachers were the very smart money operators he sought to understand. His concept of the Composite Man was a stroke of genius, a mental model that turns market chaos into a story you can actually read. His call on the 1929 crash wasn't a lucky guess. It was the ultimate proof of a lifetime spent decoding the language of the ticker tape. But maybe his greatest legacy wasn't the fortune he built, but the knowledge he gave away. He crusaded for the average person, pulling back the curtain on a world that was deliberately shrouded in mystery. Today, more than a century after he started his journey, the Wyckoff Method is as relevant as ever. Whether it's stocks, forex, or crypto, the technology changes, but the game stays the same. The markets are still driven by supply and demand, math psychology, and the operations of large interests. Richard Wyckoff gave us the playbook, a timeless guide for navigating the markets, not as a gambler, but as a student of its logic. He was the boy who spied on Wall Street's elite and came back with their secrets for the rest of us.